I mean, you added a lot of deposits.
Hey there, Lincoln here from bullacademy.org. Today we're going to do a quick reaction video from the CEO of SoFi, Anthony Nuttall, who was speaking to CNBC about the deposit growth from customers at SoFi over the second quarter of 2023, and of course since the last year and a half of having the bank charter and what that means for the business and their bottom line. And then after we listen, or during the listening, I will let you know what my thoughts are and summarize what Anthony Nuttall is saying. So if you enjoy this, don't forget to like the video and comment your thoughts. And of course, subscribe to the channel if you're not already subscribed. We will do more of these in the future if you all enjoy it. So let's dive in.
I mean, you added a lot of deposits. Now you're paying a good amount for them, over 4.2, 4.3%, but 2.7 billion sequentially. How important is that for you in terms of fueling, your ability on the other side of the balance sheet?
It's a critical point in driving both growth and profitability. So those deposits are actually a lower cost of funding for us than using warehouse lines. And we've had the bank for about a year and a half.
So before he continues, I just want to clarify what he's saying. Off the bat, he is going to talk about how SoFi makes money, which is mostly from loans. And in order to make those loans, they need cash in order to give the person borrowing the money, right? You need money to lend it out. And so SoFi has to go, and other banks, they have to find sourcing avenues. And usually they go to external partners. And that might be a warehouse loan, and they get money from there. Of course, that costs them money. But if they can get the money from internal sources, such as customer deposits, it costs them less. So the more customer deposits that SoFi has, the more they can lend out at cheaper rates, right? Less expensive loans, which means higher profits for those loans. Let's continue to listen to Anthony.
So those deposits are actually a lower cost of funding for us than using warehouse lines. And we've had the bank for about a year and a half. We've added more than $2 billion of deposits sequentially each quarter, 2.7 as you mentioned this quarter. The interest we're providing is 4.4% APY on savings if you do direct deposit, but that's actually a lower cost than what we'd be paying the big banks and warehouse lines. So it's a lower cost of funding and a more stable type of funding. 90% of our nearly 13 billion of deposits is from direct deposit customers. We want to have that primary relationship. So we benefit in two ways. One, we have the spending that they do in that checking savings account, but their deposits help fuel the growth of our lending business. And we're one of the few banks that not only provide a high APY in deposits, but we then use those deposits to drive even better returns through our loans, which have high yield, much higher than a 4.4%.
So what he just said there was exactly what I explained. They will take in money from their customers and lend out that money. Of course, that costs them less than going to the big banks and other external sources to get the money in order to lend that to other people for personal loans, business loans, mortgages, and so on. And of course, to fund their credit cards. So if they can get all that money, or a big chunk of that money from their customer deposits, they can make more profits on those loans because it costs less than getting the money from external sources. And more importantly, it costs less to fund those loans using that money than it costs to get the money in the first place. So in other words, they are attracting more customers by promising them higher interest rates on their savings and checking accounts in order to get those deposits that they then will use to make loans. And so if they can attract more customers, they get more deposits, more money, and their customers are more sticky because they are mostly direct deposit customers. 90% are direct deposit. That's huge because when the customers are direct deposit, they get more benefits, of course, higher interest rates. But for SoFi, that means that the customer is more sticky. The customer is less likely to move their money elsewhere to their second bank account, to Chase or JP Morgan or Wells Fargo, which is an awful bank. You stay away from them. Awful bank. But back to our point, SoFi has stickier customers because they are sending their paychecks to SoFi every week, every 2 weeks, every whatever the cadence is. All of their money, or some percentage of their money, goes directly into their SoFi checking and savings account, which means they will be less likely to move that money elsewhere, which ultimately means that SoFi has lower risk in lending out that money. they have more access to cash via these customers' deposits that they can then go out and lend. And that's great because, again, it's cheaper to get the money from their customers than it is to go to another bank and say, hey, let me have some cash so I can go lend it out and make my personal loans and my student loans and my mortgages work. So customer deposits is a huge deal. And over the last quarter, Q2 2023, they drove $2.7 billion in deposits from their customers. And on average, they're doing $2 billion every quarter. We've had the charter for 1.5 years. So SoFi is quickly becoming a big player in the banking space. And of course, just the last point here, it helps that they have a one-stop shop, the only true one-stop shop online bank, because that makes their customers more sticky. If their customers would have to go to, let's say, another bank to get a credit card or to invest their money, to move their money to another brokerage to invest that money, or to move their cash to somewhere else to get a debit card, or to pay off their student loans, or whatever else, right? SoFi offers all of those things in this one-stop shop so that their customers don't have to move their money anywhere else. They keep their money always SoFi. They do their banking, their credit card, their loans, always SoFi. And they get points for doing that. And so they become more sticky, which means that they will continue to use SoFi as their direct deposit, which means that they will be less likely to ever need to move their money elsewhere. Because when you have direct deposit, you don't need to move your money if you have your debit and your credit card in the same place. So the strategy is working. And I've talked about it in my optionality video as to why it's such a superpower to have all of these options in one place for both the customers and the business, their bottom line. So you should go check out that video if you haven't already. And if you enjoyed this one, do me a favor, like the video, subscribe, and share. Comment your thoughts. Let me know if you enjoyed it. If you didn't, let me know too. Let me know what you would like me to cover in the next video. We'll do more of these videos if they're helpful to all of you. So that's all for now. I'm Lincoln with BoAcademy.org. Thank you again, and I'll see you in the next one.